Evening, you're watching our budget special coverage. Budget 2026 reforms reloaded. I'm Zaka Jacob. Budget 2026 has been pitched as an engine for growth on track with Viksit Bharat. It is also India's play to counter American tariffs, targeting export growth as well as domestic manufacturing. Finance Minister Nirmala Sitharaman unveiled some key moves to move India's growth trajectory to the next orbit. But the biggest punchback was the soaring of capital expenditure at over 12 lakh crores. Ms. Sitharaman announcing an increase of 9% in capital expenditure. Hit by US tariffs, sectors like textiles, seafood, leather, etc. have also been given some relief. In short, the 9th consecutive budget presented by Nirmala Sitharaman, which in itself is a record. The message was clear and simple. You have to fire up growth and yet at the same time provide adequate cushion from these external factors. Let's bring you the big headlines, what the finance minister had to present in her budget today. Number one, the big capex increase, 9% increase. It's the highest public capital expenditure at over 12 lakh crores. Second, 10,000 crores have been given for a Biopharma Shakti scheme, which has been announced. Pharma is also something that is of concern in the tariff realm. Then the government is also hoping to lower the fiscal deficit. For the current fiscal, it's 4.4% of GDP. Next year, the glide path is 4.3% and eventually 4.2% by the end of the next 3 years. It's a big boost also for labor-intensive sectors. We talked about textiles, footwear, apparel, leather. These are all hit by the Trump tariffs. So there's some significant relief in those sectors as well. 5 university townships are going to be developed along industrial corridors. One big pain point for industry has been the students who graduate currently from vocational training institutes, from colleges, universities, etc., don't have the skill sets that the job market needs. Hopefully these industrial corridors and the university townships around those industrial corridors will solve those problems. Let's listen in to some excerpts from the finance minister's speech today. It was a big budget, a bold budget, and a budget that will put India, make it future ready for the age of artificial intelligence.
Public capital expenditure has increased manifold from 2 lakh crore in 2014-15 to an allocation of 11.2 lakh crore in BE 25-26. In this coming year, that is financial year 2026-27, I propose to increase it to 12.2 lakh crores to continue the momentum. 1.0 expanded India's semiconductor sector capabilities. Building manufacturing scheme launched in April 2025 with an outlay of 22,919 crores already has investment commitments at double the targets. We propose to increase the outlay to 40,000 crores to capitalize on this momentum. To rationalize the customs duty structure for goods imported for personal use, I propose to reduce the tariff rate on all dutiable goods imported for personal use from 20% to 10%. To provide relief to patients, particularly those suffering from cancer, I propose to exempt basic customs duty on 17 drugs or medicines.
Now, it comes in the big geopolitical context of the Trump tariffs, and the budget has sought to blunt some of those tariff threats. It has targeted export growth, particularly in labor-intensive sectors. Export growth has been given a big boost. Domestic manufacturing has been given a boost as well. Some of the measures to try and simplify customs rates as well as customs application, that I think has been given a big fillip. Also to try and reduce red tape, remove powers from the hands of the taxman. Those measures have been taken as well. Specific roadmap to try and minimize dependencies on global supply chains and to cushion global supply chain shocks have been taken by the finance minister as well. There are some duty exemptions as well as incentives on key growth areas that have been mentioned in the finance minister's budget speech. Some of the target sectors are the ones that have been hit by these tariffs, whether it's marine exports, leather, textiles, apparel, even electronics. Also, the ease of personal imports. You heard from the Finance Minister reducing it from 20% to 10% imports meant for personal use. Also, reforms to boost India's global market competitiveness as well. So, how does this offset the Trump tariffs? Well, the capex boost is a big signal that yes, India is investing in the big infrastructure story, no doubt about it. A 9% increase in capital expenditure, and this has only been increasing over the last 10 years, certainly in the last 5 years post-COVID. The allocation has now gone up to 12.2 lakh crores. There are significant duty cuts as well. Tariff rate on personal items has been reduced from 20% to 10% import for personal items. There's also a big export boost. These export sectors have been affected by the Trump tariffs. Duty-free imports have been the import limits, whether it's for seafood processing from 1% to 3%. Duty-free imports have been extended to shoe uppers, which is, of course, in the leather sector, which has also been affected. That has been mentioned in the Finance Minister's speech as well. And a big push for domestic manufacturing, exemption on raw materials for defense aircraft, microwaves, no customs on lithium-ion battery cells, solar glass, critical minerals, container manufacturing, etc. 10,000 crore outlay has been made for shipbuilding and for container manufacturing. Also, significant emphasis on the rare earth corridor from Odisha, Andhra Pradesh, Tamil Nadu and Kerala, and the announcement of the National Semiconductor Mission 2.0.
साथियों, आज भारत जिस रिफॉर्म एक्सप्रेस पर सवार है, इस बजट से उसे नई ऊर्जा, नई गति मिलेगी। हम जल्द से जल्द दुनिया की तीसरी सबसे बड़ी अर्थव्यवस्था बनना चाहते हैं। साथियों, भारत की कृषि, डेयरी सेक्टर, फिशरीज, इन्हें हमारी सरकार ने हमेशा सर्वोच्च प्राथमिकता दी है। भारत विस्तार एआई, इस टूल से किसानों को उनकी भाषा में जानकारी मिलने से उन्हें बहुत मदद मिलेगी। जो पाथ ब्रेकिंग रिफॉर्म्स किए गए हैं, वो एस्पिरेशन से भरे हुए भारत के साहसिक, टैलेंटेड युवाओं को उड़ने के लिए खुला आसमान देते हैं। साथियों, ये बजट एम्बिशियस भी है और ये बजट देश की एस्पिरेशन को भी एड्रेस करता है।
All right, let's take a look at the big picture of what this budget is seeking to address. I want to go across to two very special guests. The Chief Economic Advisor, Dr. Anant Nageshwaran, is joining us, and Mr. V. Vilnam is the Expenditure Secretary to the Government of India. Thank you very much, gentlemen, for speaking with us. Dr. Nageshwaran, let me start with you first. Obviously, this budget comes in a time and context. There's been global headwinds because of the tariffs. India is clinching these FTAs. How does this budget address those specific concerns, those specific external shocks? How does it cushion our industry, both big and small?
The budget doesn't make a song and dance about the global situation, but is extremely conscious about the global situation, and that is shown in the fact that many areas which are sensitive and important for Indian manufacturing to take off, where we could be held hostage by global supply chain disruptions or countries choosing to weaponize them, the government has prioritized. Whether it is capital equipment for nuclear energy, carbon capture and storage, whether it is aircraft components and parts, or construction infrastructure equipment, rare earth and rare earth magnets, etc., and also chemicals and biopharma ingredients. In many of these areas which are critical, even some could be high-tech, some could be low-tech, that's not the issue, but they are critical and important, and the government has quietly gone about trying to prioritize their manufacturing in India, and also reducing the customs duties on some of the components, intermediate goods that go into these areas, so that the input costs also come down. So I think it addresses two things simultaneously. One is to indigenize the manufacturing and give some thrust to it, and also by lowering input cost, it seeks to neutralize the impact of tariff and position the Indian exports in a competitive manner as well. So these are the two aspects I can think of which indirectly speak to the current global environment.
I do want to speak to you about a couple of things that were announced in the budget today, which again speak to the external headwinds. One is this rare earth corridor that's been announced linking Odisha, Andhra Pradesh, Tamil Nadu, Kerala. You know, how soon do we see this actualized? And of course, linked to that is this new National Semiconductor Mission 2.0. Where are we on that front? And because we've seen this being weaponized, Dr. Nageshwaran, in the last year, couple of years, both on the supply side, you know, post-COVID, we saw the, China plus one friend-shoring strategy that a lot of countries adopted. And now in the last year, we are seeing it on the demand side with Western economies weaponizing trade and tariffs. So speak to us about these two, the rare earth corridor and the Semiconductor Mission 2.0.
Yeah, absolutely. I think they both are critical areas. Semiconductor components, semiconductor manufacturing, semiconductor mission 2.0, all these things will play out in terms of the computing power required for diffusion of AI in the economy. And then you look at rare earth corridors. I think again they are critical for auto manufacturing, smartphones, which is India's rising success story in the merchandise export category, etc. And that is why there is a focus there as well, not only in respect of mining but also processing and manufacturing. They come on top of the rare earth mission that was launched last year. So both of them are therefore it is no surprise that they find critical mentions in the budget document today.
I want to get Mr. Vuelnam's thoughts. While the headline numbers when it comes to fiscal deficit at 4.4% of GDP, when it comes to the glide path that's been given eventually to bring it closer to 4% by the end of the decade. But in terms of expenditure, FY27 expenditure is at 53.5 lakh crores. Net tax receipts, though, are only at 28.75 lakh crores. How does the government hope to meet this shortfall? Yes, there is some amount of market borrowing, but on the disinvestment front, for example, while the target is an ambitious 80,000 crores, the government has not really matched its own targets over these last many years. So how is this shortfall going to be met?
Let me start first with the expenditure side. So whatever has been budgeted, these are an outcome of very detailed discussions that the Department of Expenditure has with the different departments, ministries, where the secretaries, the financial advisors and their officers, they all come. We look at the schemes, we look at their programs, we look at the trend of expenditures. So it's a compilation of all their requirements and not really the other way around where we try and reach a particular number. So it's a very realistic expenditure budgeting exercise which happens. Now on the resource side, the tax and non-tax aspects have been explained by the officers concerned. The disinvestment is something which has many elements to it, but I'm confident that in the coming 1 year or so, with the kind of preparations, the kind of groundwork that is happening, they should materialize, and we should be in a position to meet our requirements, and with some bit of borrowing, which we have been doing every year.
But even on the expenditure side, the fuel subsidies, the food subsidies, these are only going on an increasing trend. We're not seeing, despite benign oil prices, global oil prices, we're not seeing that getting reduced at the retail level, nor are we seeing the subsidy bill, whether it is food, fuel, fertilizer, etc., coming down in any substantial way. And add to that, this is just central government spending that I'm talking about. If you look at the state side spending, again, it's only ballooning. At what point does this get curtailed?
On the fertilizer subsidy, yes, it's a huge amount. The numbers are there, but it is also a reflection of the commitment of the government to provide fertilizers to the farmers wherever required. But having said that, how do we optimize it? How do we streamline it? The agri stack, which has reached almost full completion stage, where about 8 crore farmers have been added into the farmers registry with their ID, where the soil health cards have been issued, where the fertilizer sale through the POS, point of sale, and the IFMIS system are all now ready to be integrated, and with that the potential for optimized allocation and utilization of fertilizers and all are something very promising ahead of us. But till that time, the commitment to provide fertilizers as required stand. But with the crude oil prices also stabilizing, there will be some savings. The domestic production capacity also we expect it to be scaled up. It is something that is monitored regularly, and that will also help in reducing the import of urea, bring down the bill a bit. But till that time, yes, the fertilizer expenditure is a big item in our budget. But having said that, I don't think at this point to call that there are ballooning of expenses would be the right word, because one, on the broader number, the fiscal deficit is in the path that has been projected, and we are moving on. And even in the state governments, there is lots of consolidation which is happening, lots of stabilization on the expenditures. So public finances usually are tight, but it's on a path of consolidation.
I do want to come back to the CEA. Sir, the markets have, of course, reacted negatively because of, I guess, sentiment being affected because of the STT on futures and options trade. But beyond that, the concerns around FII and FPI money flowing out of India over the last year, again, how does the budget seek to address those concerns? Because that still seems to be a bit of an issue. Combine that now with what we're seeing, a bit of a crash, I would say, in commodity prices as well, commodity markets and exchange, funds linked to commodities. How does the budget seek to address these concerns?
Okay, first of all, I would like to make a small correction. FII, you have net outflows, but FDI, it's a net inflow. It is still positive. And it is better than in 25-26, wherein we have the data all the way until, I think, until November. I think the number is positive or even better than last year, the 24-25. So it's not an outflow. It is an inflow that is still not as much as we would like it to be, not because the gross inflows are going down. The gross inflows are coming in. It is the repatriation of profits on investments made even decades earlier, or Indian investors, Indian businesses investing overseas, that is bringing down the net number to a lower level than what we would like it to be. That's to be very precise. Now, how does the budget address this? By providing tax certainty, raising the safe harbor limits, and increasing the duration of advanced pricing agreements from 3 years to 5 years, and reducing penalties, etc., converting them into fines, or treating or decriminalizing in multiple, and also providing certainty in several areas. I think this is the way in which the budget is particularly addressing the concerns of investors in general. But more importantly, given that much of the reforms in the last 6 to 8 months have been happening outside the budget, I'm sure these issues can also be addressed outside the budget.
And just very quickly, the market reaction, you think, is just an overreaction to the STT news, and the market will come back, you reckon?
Look, markets, I think, absolutely. I think markets have certain expectations, and when they are not met, the prices that have gone up on the back of those expectations, they have to give back those gains. And STT is applicable on futures and options, if anything, to the extent that it discourages speculative activity in the market. It should put more cash in the hands of investors to be able to deploy them in medium to long-term investments in the stock market. It should be viewed as a stock market positive, actually.
Okay, Dr. Nageshwaran and Mr. Vuelnam, thank you very much for joining us here on News 18. Thank you.
You're welcome.
I also want to go across to a member of the Prime Minister's Economic Advisory Council, Mr. Nilesh Shah. Thank you very much, sir, for speaking with us. First, let's tackle with the big picture in this budget. The capex has been hiked to over 12 lakh crores like never before. It's the highest allocation for capital expenditure ever in any budget. There's a big push on infrastructure, whether it's the freight corridor, whether it is these high-speed rail lines in 7 different parts, etc. So the government seems intent that the way to tackle whatever headwinds the Indian economy might be facing, whether on the consumption side or whether on the external shock factors side. The way to deal with these headwinds is by increasing sort of public investment in big ticket infrastructure projects.
Undoubtedly, this budget has pursued the path of fiscal prudence, which is a positive thing. For the first time, we are seeing capital expenditure proposed at 12,10,000 crore, which is higher than the net market borrowing program of 11,70,000 crore. However, this budget has made many announcements which will require execution. For example, we have announced dedicated freight corridor to link Dankuni and Surat, but we can't allow it to get delayed like our existing dedicated freight corridor. We have also announced infrastructure guarantee fund to provide partial security to infrastructure lender. It should take off, unlike the credit default swap market. So outside of budget, the focus must be on execution of all the good intents announced in the budget.
So, like you said, capital expenditure has been raised to a record level, 12.2 lakh crores for infrastructure building. What do you see as the downstream opportunities for listed construction companies, logistics companies, manufacturing companies? And how do you see that translating? The capex has only been increasing over the last 10 years, particularly in the last 5 years. But how do you see that having a trickle down for companies downstream?
Undoubtedly, the focus of the capex is more towards road, railway, digitization, and I'm sure companies which are engaged in peripheral sector will see the benefit. Today, we are seeing most cement companies saying that their stocks are about of 1.5 to 2 days. We have also started seeing steel companies saying that they have increased the prices. Auto demand is also fairly strong. So there is a part of economy which is doing well, whereas there are other parts of economy which aren't doing well. In this kind of environment, it is important to maintain positive momentum, and increasing budgetary spending on capex to 12.10 lakh crore will be positive, as private investment has remained subdued.
I also do want to ask you about the markets, because there are a couple of things that happened. I'll come to STT in one second, but both long-term and short-term capital gains tax, there was an expectation in the market that some of that might be changed. Maybe, it'll be rationalized a little better, but there's been no change to both STCG and LTCG. One thing, though, that has changed is how the government will tax share buybacks, particularly by promoters, owners, etc. How do you see that change? Is it net positive or is it net negative?
So it's a step in the right direction. There were few promoters who did take advantage of dividend distribution via buyback, as dividend was getting double taxed at the slab rate and buyback was at a capital gains rate tax. Government plugged that loophole by making buyback taxable at the slab rate. It created unnecessary confusion. Now, government has taken a practical approach, dividing buybacks for non-promoters, which will be taxed as capital gain, and for promoters, which will be taxed at a slightly higher rate. So this is a step in the right direction. If people don't take disadvantage out of, people don't make loopholes out of the regulations, then probably government did not have to do this. But this is a game of chess, one move from their side, one move from government side. But I think separating buyback for promoter and non-promoter is a step in the right direction.
And finally,
it will allow
we saw
to buy shares.
The markets, how they responded to the STT being increased both on futures and on options. And, I guess a large part of the fall in the markets today was attributed to the increase in securities transaction tax. Do you think it's temporary and this panic among traders, investors will go away with tomorrow, day after, and there will be renewed interest both among domestic as well as foreign investors because the budget paints a good long-term India story?
So it's always difficult to predict short-term movement. Speculators are obviously worried because of increase in cost. But we all know 9 out of 10 speculators trading in F&O market loses money. The advantage of their losses was HFT's gain. And government is probably considering STT as a sin tax. You are not doing good for your wealth, might as well contribute to the exchequer. At the end of the day, stocks are slave of earning power. If our earnings is good, if our growth is good, markets will recover.
Okay, Ms. Nilesha, we'll leave it at that. Thank you very much for joining us with your thoughts and perspective.